Hello and welcome to Chart of the Day Cafe for Tuesday, April 12th, 2016. Just going to read our disclaimer quickly. Trading stocks has a high level of risk and viewers should complete their own due diligence on any stock or underlying that they intend to own. 100% of the content of this video and communique is intended for journalistic and educational purposes only. This video and all indicators, strategies, and articles herein should not be construed as investment advice. Thank you for your patience with that. A lot I want to cover in today's video, but as always we start off with the Russell Index. For that I'm using the IWM, which is the ETF that represents the Russell 2000, looking at it on a 5-year monthly time frame. And as regular viewers well know, we've been keeping an eye on this blue channel that the Russell traded in through all of 2014, the thinking being that the support and resistance offered here may be support and resistance over here. Having said that, this is the candle for the month of March, bullish candle overall, not a ton of volume, but nonetheless a bullish candle. We will see if the candle from April can complement that and move us higher, or this offers some resistance and we go lower. There's a sector that I am fascinated with and I really think is worth doing a bit of a deeper dive on because I think it's really important to the markets overall, and that is the financials. So for that I'm using XLF, which is the ETF. I'm looking at it on a 20-year quarterly time frame. Big, big, big. But look at the wedge that the financials are trading in right here. That is oh so interesting to me. My orange line going all the way back to 01, 02, 03. It was resistance here. Look at how it's offering significant support over here. Look at all those long wicks defending this area and the wedge that is starting to form. Yikes. Here's my thinking, and I'm offering it up to you. So far, we all know that the major indexes, the S&P, the Dow, are in that area of strong resistance. My thinking and what I'm wondering is if the financials start to break out of this wedge here, that might be the catalyst that pulls those other indexes higher. So I want to get into the meat of some of the financials that I'm looking at in particular, but before I do that, I really want to show you another chart, and that is IYT, the transports. Again, 20-year quarterly chart. Look at this great big wedge. So here's my area, rough area of support. This is the candle from the first quarter. That is a nice bullish candle. Volume starting to pick up. So a little bit of a breakout here in the transports. So if the transports are offering us this look, then maybe the financials are about to follow and do the same kind of thing. I want to flag an interview for you with a PIMCO guy from earlier in the month of March. I think it's really compelling and very much worth listening to. So I'm going to put that at the end of my video today. But let me get back to some of the financial charts that I wanted to highlight for you. And when I look at my earnings indicator on some of these financials, they are starting to perk up. So that's another reason why I think the financials might be an interesting area to really pay attention to here through this earnings season. So here's Goldman Sachs. 10-year monthly chart. This is my area of support. You can see where it offered support here, traded in this little mini wedge and had this breakout to the upside, and now we're in an even bigger wedge. Here is the candle so far for the month of April, but there's the candle for the month of March. So with any kind of follow through in April, we're moving closer to this trend line and perhaps a breakout. Same thing with Morgan Stanley, JP Morgan, they're all giving the same look, and it might be worth looking at JP Morgan because on a smaller time frame, a daily, you can see on JP Morgan, island reversal here. That might be worth paying attention to. So this very significant area of support on a daily, and look at how we're behaving here. So with Lyft, at Chart of the Day Cafe, for me, it's all about everything being up and over that 8-day EMA on a daily basis. But I would be keeping an eye on JP Morgan and Goldman Sachs, Morgan Stanley, to see how they are behaving in these areas and if they start to break out. So with that, I will leave you. I am going to play this interview that we talked about. Oops, sorry about that. For those of you that want to stick around, I highly recommend you listening to it. It is a super interesting interview with this PIMCO guy. And away we go. We'll put out a video again on Thursday. Thanks, guys. Have a good week.
You think that higher quality credit is the better play here. Why?
Well, we think that credit basically can offer near equity returns with about a third to half the volatility. We've seen three important developments this year with China, with commodities, and with central banks. All three of those risk factors we think have improved for the market tone. And credit is in a unique situation. We think it's basically a 1 in 4 or 5 year event where investors can earn near equity returns in the credit market. So spreads are basically too wide relative to economic fundamentals, and that's why there's a significant opportunity today in the credit markets.
And Mark, I understand you had identified this incredible opportunity even before we got the ECB announcement that they were getting into purchases of investment-grade corporates. How has that changed your outlook, if at all, when you look here in Europe?
Yeah, so we have been basically building out what we call the case for credit and published a piece last month called Time to Move, really saying this is a 1 in 4 or 5 year opportunity. The ECB's move actually provided another catalyst. What's important about the ECB last week is basically they announced a TLTRO, which is $1.5 trillion, and the take-up of this could be as high as 550 to 750 billion over the next several years. This is going to allow the banking sector in Europe to be able to refinance their deposits and their bonds at basically zero, and even provide an incentive to fund it up to rates as low as minus 40 basis points to make new loans. So basically, it's a very positive catalyst for bank bonds. And secondly, they announced that they expanded QE from 60 billion per month to 80 billion per month, and then went a further step of saying that they would buy corporate bonds. So this is going to help non-bank financial spreads tighten as well. But the important point is that central banks all over the world, including the BOJ, the Fed, and the ECB, are learning that this trend towards further negative deposit rates is not working. It's not working for the banking sector. And that as we transition from less rate policy to more credit easing in the real economy, that actually is going to be very positive. So the central bank developments have been huge and supportive for markets, as has been the trend up in commodity prices, and finally China, in terms of that risk factor reducing in the market.